Inflation. Beginning to hear more about it. What is it? What's the impact? And more importantly, what's the solution for investors and retirees alike? Certainly, there's been some interesting readings of late on inflation that would suggest strongly that you may want to be concerned about it. So welcome back to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on 96.9 The Game, along with News Radio WFLA Orlando networks. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure and subscribe to us on your favorite podcast channel of choice, or you can check out our YouTube channel under Nelson Financial Planning. Well, you'll see videos of the program along with other videos that members of the team do during the course of the week. So my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary. Speaking of that team at Nelson Financial Planning, we've got a team of certified financial fiduciaries that stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides peace of mind for the future. So what's inflation? I think we all know kind of what inflation is, right? It just means that the cost of stuff goes up over time, whether you think a postage stamp, although people don't use postage stamps anymore, but they send an email. But a gallon of milk, whatever the case may be, you know that 30 years ago you paid equivalently less than what you do today in terms of the absolute amount that you pay for that item. The fact that the amount of dollars that you pay for that is increased, that is in fact a perfect example of inflation. And so ultimately, with that example, what inflation does is it reduces your purchasing power over time. And you may not see that from one year to the next, but over an extended period of time, I mean, think back, 30 years ago, how much was a stamp, how much was a gallon of milk? The reality is that inflation can in fact be one of the biggest problems in retirement, particularly for the average couple retiring today, mid 60s. The odds are pretty high that one of them may very well still be alive 30 years from now. So the impact of inflation over a 30-year period of time is estimated to reduce your purchasing power by about half. That means at 95, you can only purchase half of what you could purchase at 65 with the same amount of dollars. Well, you certainly don't want that level of a surprise coming to you later on in your retirement years. So that's a significant issue that you need to be considering when it comes to inflation. If we take a step back and sort of look at what's going on currently today, well, we've got a Federal Reserve who is saying that they're not going to raise interest rates until 2023. Now, understand the biggest reason why the Federal Reserve raises interest rates is when inflation winds up being higher than what they expect. They use interest rates to help monitor the level of inflation. Well, they've already committed to the fact that they're not going to raise interest rates, which is what you would typically do to offset inflation. They're not going to do that until 2023. So that's like still 18, 19 months away at the earliest. But unfortunately, if inflation kind of pops up, that may force their hand. So let's take a look at the latest inflation data, shall we? This should catch your attention. This is from the Bureau of Labor Statistics, which is the government entity that puts together something called the CPI, the Consumer Price Index. That's how you measure inflation. And so for March of 2021, so this is last month, inflation, or the CPI, was up 0.62% for the month of March. Now, 0.62, that doesn't sound like much, but remember, that's over 1 month. And inflation is measured and they're looking to keep inflation at 2 or 3% over the course of a year. So you can see where, wait a minute, that number seems like that's a little bit higher than what it should be, and in fact, it certainly is. The 0.62% CPI for the month of March was the highest recorded rate since June of 2009. And in fact, for further perspective, if you look at the last 30 years, so that's 360 months, 30 years, 360 months, there's just been 6 months where US inflation for a single month has been over that 0.62% threshold. So that was a significant number to kind of start to watch. Inflation is certainly real, and the mainstream media is missing this little detail, particularly when you look at the number that was generated for the month of March. So what's the impact? Now that we got a data point that says, well, wait a minute, maybe there is something going on with inflation. Well, could force the Fed to start to raise rates faster than expected, which may have certainly some shorter term impact in the market, in the economy, but let's talk long term. What are the impacts if inflation does come back at a higher level than what we've seen over the course of the past 10 years? What's the best hedge against inflation? Well, my apologies to all the gold lovers out there, but that's not it. Prior show, we've talked about the returns on gold over time. The reality is that gold over time, 25 years, which again is what we're talking about, right? Because 30 years in retirement, how do you offset the impact that inflation just in normal times is going to have? It's going to reduce your purchasing power by 50% during the course of a 30-year retirement. Okay, fine. Let's look at gold over the past 30 years. It's a negative return. It's not the answer. The answer is the old tried and true, which is the best performing asset class. When you look at all the different asset classes, stocks, bonds, gold, cash, it is in fact stocks. Stocks continue to be, and owning stocks and equities in your portfolio continue to be the best hedge against inflation over time. So make sure your investment allocation has a heavy dose of that if you want to hedge against inflation, particularly on the larger company side of things. Why? Because simply put, the larger companies have the ability to pass that increased cost on to consumers. So ultimately, they've got a little bit more flexibility and a little bit more freedom to say, okay, things are costing us more, so ultimately the cost of our product is more. And if you're a large company, chances are people still need your product, and so consequently, that's why stocks historically have been the best hedge against inflation. And certainly you may sit there and say, well, wait a minute, stock market's at an all-time high right now, and so very concerned about the potential for volatility. Shoot, just a year ago, markets went down in a bit of a free fall when news of the pandemic first started. Here's the reality, and I think here's the reality that we forget about stocks and the stock market. Stocks are often at or near all-time high. Stop and think about that. When you look at the history of the stock market, it looks like a gradual slope up a mountain, which means then that pretty much on a regular basis, it goes on to set higher highs. According to Bloomberg, if you look at the S&P 500, and when it is at a price level that is within 5% of its last all-time high. Okay, so you're looking at the stock market, you're looking at where the level is, and you're looking at the market within 5% of its all-time high or at a new high, you will find that that scenario, in fact, is true 43% of the time, going back over the course of the last 70 years. So, to get this straight, this is kind of an interesting little stat, right? Since 1949, the S&P 500 has been at or near its all-time high 43% of the time. Let's not get too fixated on where the market is. Let's remember that when you're investing and when you're planning, you're talking about 30-year type of time horizons, because that's what you're fighting against. The power of inflation over time, the power of inflation that reduces your purchasing ability as a retiree by 50% during the course of your retirement. So if you want to hedge against it, the best hedge historically, don't get too caught up in where the market levels are one way or the other, but the best hedge against it certainly is owning stocks and stock mutual funds. With that thought, we will take a break and continue on with the program. Coming up next on the program, we'll talk about some of the things that have changed in the world and have affected what you have to deal with here as from a financial perspective. All that and more on Dollars and Cents with Joel Grey.